Diversification is essential in the modern world of investing. It helps us spread risks across different assets, reducing the impact of any single investment's poor performance on your overall portfolio. One of the most convenient and cost effective ways to achieve diversification is through exchange traded funds or ETFs. These funds are essentially baskets filled with a variety of stocks, allowing investors to purchase a broad selection of assets with a single transaction. By investing in an ETF, you can gain exposure to a wide range of stocks, thereby diversifying your investment with complete ease. However, the large number of ETFs available on the market can be overwhelming for some of us. Selecting the right ETF requires a careful consideration of your investment goals and your comfort level with risk. Among the many options, VOO and VTI stand out as popular choices. Despite their apparent similarities, these two ETFs have distinct characteristics and cater to different investment strategies. Understanding these differences is crucial in making an informed decision that aligns with your financial objectives. In today's video, we will dive deep into an analysis to help you determine which ETF is the best fit for your investment portfolio, VTI or VOO. We will thoroughly compare these two popular ETFs, examining their key features, differences, and benefits. By the end of this video, you will have a comprehensive understanding of both VTI and VOO, enabling you to make an informed decision about which one aligns best with your financial goals and risk tolerance. Let's get started. Thank you again for joining me today. I am Pankaj. As always, everything shared in this video is for informational purposes only. So what is VOO? Vanguard S&P 500 ETF with ticker symbol VOO tracks the performance of the S&P 500, a widely recognized benchmark for the US stock market. The S&P 500 itself represents the 500 largest publicly traded companies in the US. By investing in VOO, you are essentially investing in the top 500 publicly traded US companies. These large cap companies have tons of stability and a proven track record. Otherwise, they wouldn't be one of the top 500 companies. Many of these companies also pay out dividends, which is an added bonus. VOO features a very low expense ratio, meaning the fees associated owning the ETF are very minimal. Now next, what is VTI? The Vanguard Total Stock Market ETF with ticker symbol VTI takes a different approach. Instead of focusing on the biggest players, VTI tracks the CRSP US Total Stock Market Index. This index contains a wider range of US companies, some of the same companies which VOO tracks, while others are small cap stocks. VTI provides extreme diversification. This means your holdings are not as heavily reliant on the performance of just a few larger companies. The goal of VTI is to mirror the performance of the entire US market. It offers the potential for long-term growth that reflects the health of the US economy. Just like VOO, it also has a very low expense ratio, helping keep your investment costs down. Now the next question is, between VOO and VTI, which fund is the right choice for you? These two funds are vastly different. So let's take a look at some of the most extreme differences between these two ETFs. Let's talk about their expense ratio and risks. Before discussing performance, let's consider each ETF's financial aspects. Both VOO and VTI talk about very low expense ratios. This ratio is an annual fee charged by the ETF managers for the fund management purposes. Lower expense ratios translate to more money going toward your investment and less toward fees. Both of these ETFs are budget-friendly options. Now let's talk about risks. One way to measure risk is through beta value. Beta is the volatility of an investment compared to the overall stock market. The base volatility of the market is 1, so the further a stock's beta value moves away from 1, the more or less volatile it is. A beta higher than 1 suggests the investment is more volatile than the market, while a beta under 1 implies the investment is less volatile. VTI's price swings a bit more than VOO's, as it contains small cap stocks that tend to fluctuate more. However, this difference is very low. Overall, these stocks are very similar in terms of fluctuations. Currently, VOO's beta value is 1, while VTI's beta is 1.01. That's not a huge difference though. Let's check their historical performance. While past performance is never a true measure of future results, it can offer some insights. Historically, VOO might have a slight edge in terms of returns percentage. This is not surprising considering its focus on large cap companies. These established large cap players tend to deliver solid, steadier, and sometimes less explosive growth. However, VTI includes small to mid cap stocks alongside large cap, offering the potential for higher long-term growth. Broad exposure does come with the potential for more volatility, as smaller companies are more sensitive to market movements. Here is some data comparing the results of each of these ETFs. VOO's year-to-date return is almost 15%, whereas VTI year-to-date return is almost 14%. VOO's return since inception is 12%, whereas VTI return since inception is almost 7%. The last 1 year return for VOO is almost 27%, whereas for VTI, the last 1 year return is almost 25%. Let's check the top holdings for VOO and VTI. Looking at the specific holdings can offer further insights into each of these ETFs. VOO, with its focus on large cap stable companies, will obviously have established giants like Apple, Microsoft, and Amazon at the top of its list. These companies are known for their strong track records and tend to be major players in the market. VOO's top 10 holdings are Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, Berkshire Hathaway, Broadcom, etc. VTI, on the other hand, has a slightly different style. As we have discussed, it focuses on diversification. This translates to a wider range of stock holdings. While you will find many of the same large cap companies present in VOO, further, VTI also ventures into smaller and mid cap companies across various sectors. VTI's top 10 holdings are Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta, Berkshire Hathaway, and Broadcom. While the top 10 holdings of these ETFs are basically the same, the percentage that each company makes up varies. So, in conclusion, the decision between VTI and VOO ultimately depends on your personal risk tolerance and investment timeline. If you are seeking long term growth and want a broad, diversified portfolio, VTI is the better option. VTI covers all types of US stocks, including large cap, mid cap, small cap, and micro cap stocks. This broad market coverage provides a wide range of investment opportunities and spreads your risk across many different sectors and companies, making it ideal for investors who are looking to hold their investment for a longer time. On the other hand, if you prioritize stability and prefer to invest in well-established companies, VOO might be the better choice. VOO focuses on the largest US companies within the S&P 500, which are generally considered more stable and reliable. This concentration on blue chip stocks can offer a steadier and solid performance, which is beneficial for investors with a shorter investment horizon or those who are more risk averse. Ultimately, the choice between VTI and VOO should align with your financial goals, your investment strategy, and how comfortable are you with market fluctuations. Understanding the difference between these two ETFs will help you make an informed decision that best suits your needs. If you enjoyed this analysis and want to stay updated with more investment insights, make sure to hit that like button and subscribe to our channel. Until next time, happy investing.